Welcome back to another video. Today, I'm going to talk about GameStop saga and try to explain how a group of amateur investors broke the stock market and proved the experts wrong, costing them billions of dollars. If you're interested in staying up to date with the latest news and politics, consider subscribing to the channel. And with that, let's get started. So to follow this story, there's basically three things that you need to understand. 1. The subreddit Wall Street Bets. 2. GameStop, and 3, how the stock market works. Specifically, what does it mean to short a stock? So let's start there. So traditionally, when you invest in the stock market, you buy shares of whatever company, and as the value of those shares go up, you make money, and if the price goes down, you lose money. But when you short, you actually make a profit when the price of the stock goes down. And this is how that works. So let's use bananas as an example. Let's say I believe that the value of bananas is going to go down in the future. So what do? Let's say bananas today are worth $10. I go to a shopkeeper and I borrow one banana. And then I find someone who is looking to buy a banana and I sell it to him for 10 bucks. Now right now I've not made a profit. Yes, I sold a banana to someone for $10, but I also owe one banana to the shopkeeper. So I'm net zero. Now let's say tomorrow, or at some point in the future, the value of that same banana goes from $10 to $5. Now I can go back on the market, buy a banana for $5 and return it to the shopkeeper. He got his banana back and I made a profit on the difference. So essentially I've shorted a banana. The same concept, the shorting a stock works the same exact way. However, shorting is far riskier because let's say in a traditional investment, I put in $100 and I bought shares of company XYZ. Let's say that company goes bankrupt, it's worthless, the price of the stock goes down to zero. And so the most amount of money I can lose is essentially 100%. Whatever I put in, it all vanished, I'm left with zero. But when you short a stock, your losses can theoretically be infinite. And so the way that works, so in our example, in the banana example, the price went down and it worked in my favor. But if I'm shorting a stock, what if the opposite happens, right? What if the price of a banana, instead of going down from 10 to 5, it actually goes up from 10 to 20 or 50 or 100 or 1,000? It can go up to whatever, and I would still be obligated to buy those bananas at whatever the market price is now and return it to the shopkeeper. And also keep in mind, borrowing those bananas from a shopkeeper is not free. I pay interest for every day that I have those bananas borrowed. So the combination of two, the losses can actually be substantial. So hopefully now you have a better understanding of how shorting a stock works. So next, let's talk about GameStop. Now, GameStop is, if you don't know what it is, it's basically a brick and mortar retail store for video games. But in today's day and age, you can just buy and download games directly from the internet straight to your console without ever having the need to go to a store. It's essentially the same concept as Blockbuster and what happened with the introduction of Netflix and other streaming services. It just became a dying business model. And the same is the case for GameStop, but for video games. So, big time hedge funds saw this as a perfect opportunity and started placing massive short positions, to the point where GameStop actually became the most shorted stock on the market. They actually had a 138% short position at one point. What does that really mean? That means that there were more borrowed shares of GameStop on the market than were actually owned. How do you even get to that point? For that, let's go back to our banana analogy. So, I wanted to short some bananas, right? I borrowed them from shopkeeper and I sold them to some third person. There is nothing stopping that third person to then lend those bananas to a fourth person who then sells it to a fifth person. So essentially, these same bananas have been borrowed twice, are owed back twice, but are only owned by one. So, just a quick little recap. Now you know how shorting a stock works, you understand what GameStop is and their failing business model, and you understand that there is a massive short position that is negatively pressuring the stock price, and the stock price is declining. So what changed? What caused that stock price, which I believe was as low as $4 at one point, to skyrocket above $400 within a very short period of time? For that, enter Wall Street Bets. Now, Wall Street Bets is a subreddit, essentially an online forum for people to talk about their thoughts and ideas on investing, trading, stocks, that sort of thing. It has become insanely popular with over 3 million active users. And someone, or I guess a group of people on that forum, realized what was going on with GameStop and saw that massive short position from the hedge funds and thought to themselves that if we band together and start buying and holding shares of GameStop, this will increase the demand and decrease the supply, forcing the price to go up and triggering a short squeeze. A short squeeze is essentially where people with short positions desperately try to go out there and buy their shares that they've borrowed before the price gets too high. Essentially, they're trying to go out there and buy the bananas and return them to the shopkeepers before the price gets even higher and higher. The hedge funds are losing a lot of money, but if they cover their positions now, they'll prevent losing even more money in the future. And that is exactly what happened with GameStop. Now, this idea went viral on Wall Street Bets. You had a bunch of Billies and Timmies and Jimmies all going out there and buying shares of GameStop. Whether that's a couple of $1,000s or a couple of hundred, collectively, these retail investors were able to buy and hold a substantial amount of shares, driving the supply down. And on the flip side, these hedge funds were desperately trying to buy these shares, increasing the demand. The combination of the two was a perfect short squeeze, and this drove the price to go up exponentially high. One hedge fund in particular, called Melvin Capital, held a $55 million short position against GameStop and had to take an outside funding of $2.75 billion just to cover losses and stay afloat. However, despite short selling funds losing a collective roughly $20 billion so far, short interest in GameStop is only down 8% from last week. In other words, I believe the battle of wills between retail and institutional investors is far from over. If you find any value in these videos, be sure to like and share with a friend. And as always, thank you so much for watching. My name is Arif, and this is Morning Coffee.